Assalamualaikum. Hello and welcome to Gurukul Online Learning Network. Today I'm Sheikh Mahadi with you. We are going to study Finance and Banking, Chapter 4, Financial Statement Analysis. In the previous lessons, we learned about how to complete the financial statement analysis. It's a very easy process. Sales minus cost of goods sold, that we get gross profit. After that, operating expenses minus interest expenses. That's how we get the net profit. So, in the previous lessons, we learned about how to finish a financial statement up to the net sales. So today we're going to learn about the other sections of the math in this chapter. They are included. So let's take a look at profitability ratio. Profitability ratio, this section has some kinds of math, 3 to 4 types of math. So what's a profitability ratio? A company should earn profit to survive and grow over a long period. So a company is not a short term, it's a very long term project. Within that, your company has to be sustainable by making profits repeatedly, continuously, whatever word we use, but a company has to stay in the market by making profit, or else it will be totally dissolved. Profit is the difference between revenues and expenses over a period of time. Usually it is considered 1 year. So profit is the difference between revenues and expenses. What's profit? Suppose we bought a good and we stored it in our own warehouse, then we sold it at an amount that we bought a little bit higher than that much portion. When we sold it to the more portion that we bought, that portion is called our profit. That's why I said difference between revenues and expenses is called a profit. Usually it is for 1 year in every kinds of company. The profitability ratios are calculated to the measure of operating efficiency of the company. There are any measures of profitability as a group of members measures the enable to analyst the evaluate firm profit with respect to a given level of sales, certain level of assets or owner's investment. Without firms, a firm could not attract outside capital. So what's the meaning? Like a firm cannot attract the outside capital. What's an outside capital? In case of public limited companies, they issue share to the general market and the general people. Those shares are called the outside capital. General people won't be willing to buy our shares even if our company does not have enough profit or it's not enough reputed in the outside market. So that's why normal people won't be willing to buy our shares if our company is at huge loss or it's currently running on a daily basis of loss. So we have to be in profit to gather outside capital. So owners, creditors and management pay close attention to boosting profits because of the great importance placed on earnings in the marketplace. What does that mean? Owner, creditors and management. It's like same alternate to the same line, previous line. I just said that outside capital. So when they take more management or take more efforts into boosting profit of the company, that's how if they boost the profit of the company will be reputed. It will have a goodwill in the outside certain markets. That's how we will gain outside capital. We will get trust and confidence of the outer general people. So that's how we can increase the capital and the profit. So capital and profit ratios are always 1:1. That's how. So let's take a look at the maths. Gross profit margin ratio. What's the gross profit margin ratio? The gross profit margin ratio measures the percentage of each sales amount remaining after the firm has paid for its goods. Firm has paid for its goods. Like we bought a product, a raw material, we converted into a good sellable goods. After that, all the cost that we included in while converting into a sellable good, that is called the cost of goods sold. And after selling that, the much proportion that we get from selling it and the produce when the raw material was bought into hands, if we minus that, we'll get a certain amount of money. That is called mainly profit. But gross profit margin ratio, that's totally different. We take out the gross profit and the sales, we divide it, we'll get a gross profit margin ratio which is equal to the percentage. So the formula for the gross profit margin ratio would be gross profit divided by sales. As we know, gross profit was taken as sales minus cost of goods sold. We can get easily gross profit, and then gross profit divided by sales. So we'll take the amount of gross profit 9,086,000 and sales would be 3,074,000. If we divide that, we'll get 0.32. Converted into a percentage, that will be 32%. So 32% gross profit margin ratio according to the previous maths. So let's talk about the second one, operating profit margin ratio. What is that? Operating profit margin ratio measures the percentage of each sales remaining after all costs and expenses other than interest, tax or preferred stocks. Those are just totally different. The gross profit margin ratio, it calculates the entire profit and the sales, but the operating profit margin ratio, it takes each sales. The amount, suppose in a unit of 35,000, we will take and measure all the 35,000 unit within each. Each sales is calculated individually over here. So we'll have a easy formula for that. Let's take a look at that. So operating profit margin ratio would be calculating the amount of each sales profits in excluding the taxes or the preferred stocks. So we learned about EBIT. What's EBIT? It's like earning before interest and tax. We learned it in the previous classes. So EBIT will take a random number, and for the sales we'll take another random number for that. So EBIT will take 4,18,000. So 4,80,000 divided by 3,74,000. We'll break it down to a point. If you just break it down simply, we'll get a point of 1360. That will be 13.60. or 13.60% for each sales remaining after all the costs. So let's hop on to the next one. Net profit margin ratio. What's a net profit margin ratio? The net profit margin measures because percentage of each sales amount remaining after all cost expenses including interest, tax and preferred stock dividends have been deducted. So the operating profit margin ratio that we just did, it was excluding those, excluding all the interest, tax and preferred stock, and the net profit margin ratio, it includes all the interest, taxes or the preferred taxes. EAT. What's an EAT? Earning after taxes. All the earning we earn after paying the taxes. That's called an EAT. EAT divided by sales. It's a net profit margin ratio's basic formula. Earnings after taxes will pay a 22,100. 2,200, 1,000. So just simply break it down to a percentage level. We get 0.720. That will be 7.20%. 7.20%. So the total gross profit margin ratio in this profitability margin ratio, we can take almost 4 to 5 kinds of math. So far we learned about 3 types. So fourth and fifth one would be earning per share EPS ratio, and the fifth one would be return on assets investment or ROA. Sometimes it's called ROI and sometimes ROC. So let's take a look at earning per share EPS. Per share that we buy. Each share we buy and the earning we get within each share. People do not buy one share. Usually they buy hundreds of thousands of shares sometimes, if it's less in amount or value. So what's an EPS? The earning per share represents the number of amounts earned during the period on behalf of each outstanding share of the common stock. The amounts are earned, actually not distributed to the shareholders. EPS amounts are earned, not actually divided. How share works? Share basically works, if you bought 5 shares and our company is making profit at the end of the year, whatever profit the company made and whatever percentage or the amount of proportion share we bought, our capitals, within our capital limit, our profits will be divided equally into all our shares. But in this case, we have to earn through those shares. Those shares would be earned, not divided among all the shareholders. So it's a basic formula for that. EAT would be divided by number of common stock, that number, how many stocks or the shares we bought. And like that, before the formula, EAT remains the same. It's an EPS. the amount of sales would be the number of common stocks, the amount of stocks that we bought, that was 76,262. 76,262, and the earning after taxes, all the earning that we did. So it will be as the previous number, 221,000. So let's just divide it as usual. There won't be any kind of percentage because we are learning about the earning per share. It will be directly into taka, not any kind of percentage or any kinds of ratio profitability. 2.90 taka. It will be almost 3 taka. So that was the earning per share. Let's hop on to the last math. So return on assets, as I said, return on asset, return on investment, or return on capital, ROA, ROI, or ROC. So what's an ROA? It measures the overall effectiveness of management in the generating profit with its available assets. So let's take a deeper look, or let's explain the math, explain the line. Measures the overall effectiveness of management in generating profit. The management usually generate profit. Without management, profits or losses both can be generated, or without management, a company will cease to exist basically. So that's why if the management is working hard, they're putting their all efforts into it, they're generating profit with its available assets. It is also called return on investment, ROI, the return on capital, the same. The higher the firm's return on investment or asset will be, the better it is for each company. So ROA. Return on assets. Return on assets will be earning after taxes, the same, EAT divided by the total assets or the capital. So our EAT would be the same as the before 20,000, 2 to 1,000, or let's take a look at the 3,597,000. So earning after taxes divided by total assets or capital. It will be in the percentage, not as the before, as we learned in the EPS. Earning after share, it won't be as in taka. It will be in profits, or it will be in ratios or in percentage individually. Sorry. So that's all the profitability margin ratio. So if you have any kinds of question regarding this lesson, please let us know down in the comment box below, and be with Gurukul. Thank you.